I'm Nick Grove for Morningstar.com.au, and today I'm joined by Stephen Miller. Steve, what are going to be the main macroeconomic challenges that investors are going to confront as we head into 2016?
I think the main challenge is probably a policy one. I think markets have been trying to assess when the Fed is going to engage in policy liftoff, that is, increase interest rates. Markets have had a couple of false starts. I think at the start of the year we might have thought it was June, then September. Some of us are now December or March. And I think what we're waiting for is how other markets might react to that. So, we saw the more pessimistic among us might see a review of the taper tantrum that we had back in May 2013. The more optimistic among us might sort of say, well, markets have discounted the Fed rate rise. And in any case, this will be a very cautious period of tightening monetary policy, not like those that we've seen in the past, which have been fairly consistent and applied. So I think that's probably the major challenge, Nick.
And Stephen, when it comes to equities markets, where are you seeing some of the good opportunities at the moment?
Well, globally, we favour Europe and Japan, and a couple of reasons there. One is those markets have been pretty beaten up, and they're showing sort of pretty solid 12 months forward earnings growth. So that's a good thing. I think the second thing is those markets have the most policy tailwinds. So both the Bank of Japan and the ECB are engaged in what we call quantitative easing or unconventional monetary policy or shorthand printing money. And whilst ever that keeps going, whilst ever the monetary spigot keeps gushing, that's a good tailwind for those particular equity markets. So Europe and Japan, also like US cyclicals, because we're not so negative on the US economy. We think it's growing okay. I think overall, though, we'd like to sort of see some earnings growth underpin the performance of that market, and so you might get that in the area of US cyclicals.
And just finally, Stephen, what about fixed income and alternatives? Should all investors be considering an exposure to these?
It can depend on one's risk appetite. We do know that developed market sovereign bonds are very, very expensive. I'm a bond manager, and we acknowledge how expensive they are. They may stay expensive, but acknowledge they're expensive, and perhaps you might want to think about whether they're as good a diversifying instrument to the more risky assets as they once were. Now, they may well be, but these are the things you need to be cautious about when looking at fixed income. Bonds issued by corporates are a little more interesting. They've had a reasonable adjustment, got a fair bit cheaper, unlike sovereign bonds over the last year or so. And on the assumption that, global growth's okay, that policy remains reasonably accommodative. That is, the Fed only engages in cautious tightening. We've still got those QE tailwinds elsewhere. Certain pockets in there might look attractive. So they're the sorts of things that we're looking at. Perhaps also emerging market hard currency debt. But again, I think country selection is very, very important here. And we'd look at places like India and Mexico, which have good governance, governments involved in reform agendas, as being, more favoured destinations in that context.
Stephen, thanks for your time today.
No problem at all. Thanks, Nick.
I'm Nick Grove at the Morningstar Individual Investor Conference in 2015.